Hey guys, this is Toby Mathis.
Jeff Webb.
You're listening to or watching Tax. We're coming through, all right. We're having some fun stuff with technology in our building. So I want to make sure you guys can all hear us loud and clear. So please let me know that you can hear us.
And me too.
Good here, good here. So every now and again, Citrix likes to say, hey, your audio is coming through funny. So I don't know whether to listen to it or not. I'm just going to ignore it. All right, so let's just jump in. We got a lot to go over. And first thing we want to go over is where you can always get lots of information. And there's lots of different places. All of them start with that aba.link and then the /, and you can put in Facebook, YouTube, LinkedIn, Instagram, or Twitter, or all of them if you like to get multiple sources of information. And there's actually some really cool stuff. And actually, I'm going to ask Susan. Susan, you know the link for Infinity Investing. I believe we have that coming up. I didn't make it into a slide, but I want to give everybody the opportunity to, I think we're May 23rd. Can you make yourself unmuted so you can just verify that you're out there and alive and that it is May 23rd. I believe that we have another Infinity Investing coming up, and yeah, put the link in chat. So we've been having a lot of fun with the Infinity stuff, guys, because if you were watching well over a month ago, we've been spot on as far as what's been going on. So we feel pretty comfortable going forward. It's not rocket science. It's just playing what usually happens. So I can't hear Susan, but maybe she'll put that up.
I'm here. It is Saturday, May 23rd. Starts at 9 o'clock, should run until about 5. And if anybody's interested, I'll post the link in the chat as well, but it's aba.link/IIW.
Yep, I will write that up before we're done, but I like to put some freebie stuff. Have it, whoever you can come on in and join us for another day. We did a webinar earlier this week on just stocks and bonds. What is it, Tuesday? I guess it was yesterday.
Yeah.
It's already been a long week, right? And we had a whole bunch of companies that we're going to go through in this particular Infinity workshop. So it's not going to be like all the others. We're actually going to go through a whole bunch of the companies. We're going to do some deep dive into their numbers. I like looking at historical data, and it's pretty obvious when you look at historical data and charts on some of these companies. So it was fun. So there it is. There's some folks that attended yesterday. So people seem to be enjoying it. And hi, David. He's out there. And thank you for the compliment. All right. So Patty put it out there. See, somebody actually likes me. Usually they're just giving me some shade.
But apparently you were there too.
Apparently I was, although I don't know where my brain was. All right, so Tax Tuesday rules. I may have bitten off more than Jeff can chew today, because there were just so many cool questions, and I just started going through and say, this is a good one, this is a good one, and then the next thing I know, I'm like, hey, we're supposed to do that in an hour. There's no way. All right, so you can always send in questions at taxtuesday@andersonadvisors.com. We're getting hundreds a week, just so you know. So if you think you're going to get a response in a day, it's probably not going to happen, although our guys are pretty good about getting stuff. We grab the questions that are up here every week from those Tax Tuesday. If you need something super specific on a tax issue, you're going to have to become a client. If not, then you can always ask. And I'll tell you what, a lot of CPAs are hitting me up. I am part of a bunch of listservs, and I can tell you there's a lot of misinformation going on out there on the tax impact of the CARES Act. In fact, this is an image for you, Honk, if you hate the IRS. I usually, I never beat up on the IRS, but I'll tell you what.
Lately, the SBA and the IRS are doing everything they can to undo what Congress did, and they're really pissing me off. And I never say that. I always say the IRS, you treat them like a police officer, right? Well, hey, cop, you're pissing us off. You're undoing what Congress is doing, and it's not just me. It's actually Congress who's saying it. So what they did is in the CARES Act, they give us this PPP loan where you get a tax benefit of this loan forgiveness. And then the IRS somehow concocts it and pulls it out of their ear, wrong orifice, but they pull it out of somewhere, that somehow we're not going to let you write off these expenses because it would be exempt income. It's like, it's stupid. Like we sit here and go, that's absolutely asinine. You didn't read the cases you cited, which is typical of these guys. I love cops, David. It's cops are awesome, but in this particular case, the IRS is acting like a knuckleheaded cop, and we have to call them out on it. So what they basically did is they came up with this idea that somehow we're not going to let you write off the expense, and that's really annoying. That is just not true. That's not what they intended. How do we know? Because Senator Grassley comes up and says, when we developed and passed the Paycheck Protection Program, our intent was clearly to make sure small businesses had the liquidity and the help they needed to get through these difficult times. Unfortunately, Treasury and the IRS interpreted the law in a way that's preventing businesses from deducting expenses associated with PPP loans. That's just the opposite of what we intended and should be fixed. This bill will do just that. So they just put out some new legislation literally in the last hour that is going to undo that. Jeff is probably learning about that as he's sitting here, unless he got hit with the same.
I have not heard that yet.
Yep. So the House just put it out there, and I'll show you what that is. And then the IRS does its best to do some other stupid stuff, which is they took a notice at this very bottom here. You guys would learn to love to read this stuff. This little notice down here that says 2005-92, and they applied it to the new law, even though the language is completely different. But since when do we want them to actually do their jobs? They're all off anyway. Hardly any are working. Like, are you able to get anything done?
No, when I call, the phone usually says we're not giving personal service at this time.
So somehow you got Amazon working their Katusha off. You have Costco working their Katushas off. We have people, unless you're a hairdresser, in which case, no, they just reopened here. But the IRS apparently can't do their job. Gosh darn.
I would have kind of thought that people who collect money for the government would be essential.
Yeah. Somebody says, can you check on your stimulus check? Yeah, there is a online. They managed to screw that up too. Don't expect it to work too great. And they keep giving money to dead people, and now they're mad because they said you have to return it. But how the heck are they going to force you to return it? Because they just gave money to a deceased person. How are they ever going to get that back? What do they do? Sue the deceased?
Yeah, I guess the IRS is the new grave diggers.
I don't know how they go do it. Like, I'm just trying to think this through. I gave money that I shouldn't have to somebody out of the country, and I gave money to somebody I shouldn't have who's deceased. I guess you would have to try to do some discovery and figure out who actually took possession of those monies, or maybe you sue the estate. I just think
apparently it's not as easy to give away trillions of dollars as it looks like.
I'm just mad at them. But anyway, so the IRS did this weird 3-year where we said, hey, as long as you pay it back by the end of the 3rd year, if you take an early withdrawal from your retirement plan, you don't have to pay it back technically until the end of 2002. And the IRS wants you to pay tax on that and then go back and amend all of your returns. That's their theory. And we think that's stupid. And I think that we're right because it is stupid. So anyway, here's the HEROES Act that they just passed. So you're learning about it right now because I learned about it right before we went on the air, and I was feverishly reading as much as I could. And at the very bottom here, and I won't spend too much time on this stuff because it'll probably bore you to tears. What they did is they said, hey, we're going to modify the Paycheck Protection Program so you can deduct the business expenses. This is really sad. When Congress is giving benefits to small businesses, and I'll use the PPP as an example because you're supposed to use 75% on payroll expenses. But it does not say that in the law. The SBA pulled that out of another orifice and threw it at us, right? That is not the intent of the law. And now you have Congress who shows up once in a while. Like, I don't even know if the House is in session. I know the senators showed up, but I'm not even sure if the House is. But do you know if they're there?
I don't know if they're there or not.
Yeah. Anyway, so I'm just like annoyed. So I'm sorry to be annoyed, guys, but I'm just looking at this going, why do we have Congress having to undo what our bureaucrats are doing? So that's going to be my theme for the day is bureaucrats are ticking me off because it's hard enough right now for some of y'all to make a living. It's really brutal out there. We have really had some difficult times, and a lot of it's self-inflicted. And I get that there's the virus, and I'm not belittling that virus, but we are in a serious financial crisis if you are a small business owner, and they're not making it easy. And I met with a gentleman earlier today, a friend of my wife's, who is an independent contractor who has not been able to work for the better part of 2 months, who has not been able to get through to the unemployment to get any monies whatsoever, and has been forced not to work as a non-essential business. So I just look at it. Somebody says, how does that work with stimulus payments to widows and their deceased husbands? The widow would still get it. The deceased husband's not supposed to, but they've been paying the deceased husband anyway. Mm-hmm. And I don't know how they're going to come back and get it. They're telling you that you have to return it or they'll penalize you and charge you a bunch of interest. But I'm like, good luck finding it. You give it to somebody who's passed. Anyway, I'm getting all crunchy. Sorry, Jeff.
No, that's fine. I totally get it. Because we see so many of these financial aid plans, whether it's unemployment or the CARES stuff or even the Fed, they're not working well. Even the stimulus check is not working well. It's going to the wrong people. It's not going to people who need it. And we're seeing a lot of this with all of these different products that are trying to help people out.
Mm-hmm. Yeah, well, somebody says, can you deduct more than just payroll like insurance and medical premiums? That's actually a question that we're going to answer today on the PPP loans. And Susan asked the same thing. Do I really have only 8 weeks to use my PPP money? And yeah, well, yes and no. It's a loan no matter whether you use it or not. But if you want it forgiven, then yes, you have 8 weeks. It's called a covered period. But they're trying to relax that so you don't have to use it all on payroll. Right now it's 75% payroll. But
at least 75% payroll.
But that is stupid. Because like Jeff, you and I, we've tried to hire people in the last few weeks, and nobody wants to get hired because they make more on unemployment.
Correct.
So if you pay less than $30 an hour, most people are going to be like, I make more just chilling at home. So now my competitor is the federal government giving money to somebody not to work. So they should have thought about this, and the forgiveness is based on me paying it. So they've given us some guidance saying, hey, if you try to hire people back and they don't want to be hired back because they'd rather be unemployed, you can still count them as an employee. And I'll show you why that's relevant when we go through some of the rules. All right, so let's jump into what we're going to go over today. Made a backdoor Roth IRA contribution 2 years ago. It's a mouthful. If we need cash flow now and pull it out, since we already paid taxes, is it just a 10% penalty? I'll explain what all that means. Also, it does not sound like Roths are eligible for a 3-year roll like normal IRAs under CARES. We will answer that. If I have a loss in my S-Corp in 2019 and 2020 and from a 1244 stock, can I carry it back to recoup taxes paid on my personal 1040s? So that's interesting. So they did a 1244 stock loss. Okay, we'll answer and we'll explain what all that. Jeff's like chilling, totally sitting back going, he just nodded his head like, yeah. I got that one. Good. Can you tell me a couple really good strategies to quickly recover the tax benefits from capital losses? I have a sizable amount of loss I want to recover sooner than later. My wife is 60. In 2019, she had $13,200 of Social Security income and zero earned income from work. Can she contribute to her health savings account for 2019? We'll go over that. I started my own cruise agency mid-February. Sales were strong, but then COVID arrived. Everything stopped, and industry experts believed it will now take 6 months to a year to rebound. Like, this is a sad story, and we'll go over it. I applied for the federal stimulus $10,000 funds, but have still not received a response. I have tried many times to file for unemployment, no success. This is common, guys. In my state, people have still not been able to get their unemployment. It is absolutely ridiculous. Anyway, I still have not received the $12,000 check from the government. Plus, I have not filed 2019 taxes. What options do I have? I'm sinking here. And I hate the fact that she used sinking because you use cruise, and I immediately think Titanic, but I feel really guilty for having that thought. But I'm sinking here without earning any income. So we'll have some solutions for you here. What is the best way to set up a real estate LLC if you're an investor that does both buy and hold and fix and flips? We'll go over that. If I pull equity from house, does money need to go back into the house, or can I use it on another property or for other things? We will go over that. Can we write off donations to our nonprofit, even though we've still not been approved for that 501c3 status yet? That's a great question, and we'll answer it. I own a dental practice. I am purchasing a new commercial building through a new LLC to add a new location and then rent it back to the business, which will operate as an S-Corp. The building purchase will be cheaper than the rehab with the new CARES Act changes, et cetera. What are the best tax benefits to this situation? It's a really interesting situation to be in. It sounds like you just got made, you're going to be very happy under the CARES Act. Will there be a penalty, forgiveness or tax for paying an employee more than the average 2019 salary calculated PPP because of overtime or catch up with pension plan payments, etc.? If you purchase vacant, unimproved land with the intent to build, develop homes for sale or rent within 1 or 3 years, what tax advantages can be taken? Are the LLC business expenses for it, as well as interest taxes from the loan, able to be included on a Schedule E like a normal property? And then another one, LLC owns mortgage notes. Can the LLC file for the economic injury disaster loans or EIDL? Those are the SBA disaster loans to recoup non-payment loss. We'll answer that. And this is where I realized that I probably got...
You did ask a lot of questions, didn't you?
I couldn't resist. I used to work, you're okay being here till midnight, right?
Yeah, that's right.
I used to work for New York State and had a 457B, that's a government retirement plan. I left the state job 5 years ago. Is there a way to withdraw all of the 457B funds? I do not want the 457 amount to count to the $100,000 CARES Act withdrawal because I want to take out a separate $10,000 from a 403B using the CARES Act. So they have a 457 and a 403B.
Right.
If I pay my home personal internet bill with a personal credit card and then pay the personal credit card transaction with my business checking account, is this considered piercing the corporate veil? Happy to answer that. If my C-Corp reimburses for vehicle mileage, how do I then do my personal and C-Corp taxes? You're asking very happy questions for Jeff. Like he's excited today. He's like bouncing up and down in his seat. So either he's sitting on a tack or he's excited. I don't think I've ever seen you bounce. That's kind of neat.
I don't do the Tigger.
I use a Series LLC. That's actually pretty cool. And again, we'll go over what all this stuff means. I'm a passive investor in apartments. So Series A has apartment 1, B has apartment 2. Each series has its own EIN number. It is a single member LLC, but their series, always interesting. So when I do my taxes, it flows through to my personal taxes. This year, my K1s have to have my personal social security number instead of the EIN. I also have rental houses in the series LLC with separate EINs. My question is, if a renter tries to sue me, could a good lawyer reach into these other LLC because the government associated my SSN with these LLCs? So that's a really big question, and we will answer it. Can we write off passive loss with any taxable income, W-2, stock gains, active income, K-1 under CARES Act? Would you please elaborate on it? How much passive loss can we write off? Is that up to 100% taxable income? By the way, we are not a real estate professional. So we're going to give you an answer, and then you can cry about it. What is the PPP? I think that's what is the messing up. What is the PPP forgiveness criteria? So that's, a lot of you guys are asking that. So I actually have the criteria that I grabbed and stuck into the presentation on a whim. Even before this whole virus situation hit, we had a few tenants who skipped town early on their lease while also owing us back rent. So the total amount in this case, for example, including the 2-month penalty for breaking the lease, is $3,300. What do we have to do in order to be able to claim this as a loss on taxes? Right. We'll get into that. There's a lot of rules that get triggered. My mom is 83, bless her heart, and I hope that she's doing well. And when she dies, I love questions like this. My mom's 83, and when she dies, she wants to leave her house to me and my 3 siblings. She currently has about $100,000 in equity, so each of us will receive around $20,000, or which I'm trying to do the math. So there's 4 siblings, so that would be about $25,000. No. After we sell the house, well, I guess you got to have the costs. Mm-hmm. We'll go over this. Should we transfer the house into a revocable trust with my brother and her as trustees to avoid probate and reduce our tax liabilities? Purchased rental property, did a cost segregation, property appreciated greatly, did a 1031 exchange after 10 years. Wouldn't the fair market value of the section 1045 property have to separate out and the gain recaptured as ordinary income? Somebody's asking, that's really smart, because the fact that you're breaking this out means you know a little something about what you're doing, but the answer will surprise you. Section 1031 does not apply to 1045 property. So we will answer all of those.
Yes, we will.
You probably are excited for that one. Whenever Jeff sees a really weird kind of out there question, I like to see whether he's getting ready for it, because that's one that has a weird answer. A lot of these have some funky little, you're getting out there.
Yeah, I like the questions that make me say, wait, what?
I know. So just so you know, I get these. Jeff gets to see them the morning of, and I usually look at them at about 30 minutes before we start to throw them into slides. So if you ever see the slides like all over Pollywonkel, it's my fault, because I wait till the last second to put them into slides. All right, so let's jump into these. Woo! Backdoor Roth IRA. Do you want to go over what a backdoor Roth IRA? Because it just sounds untoward.
A backdoor Roth IRA is a contribution to a Roth that is actually made to a traditional IRA first. It's a non-deductible contribution to a traditional IRA.
Because you can't put money into a Roth because you made too much money.
Exactly. And then you immediately convert that traditional IRA into a Roth IRA. Mm-hmm. You can do this every year or so.
So if you make too much money and you phase out of the Roth IRA rule, so you can't make a contribution, some people say, hey, I'll just put money into a traditional and I will convert it.
And IRS is fully on board with this.
Yep. So they call it a backdoor Roth IRA. So now you did that. So let's say I did a backdoor Roth IRA and I pull the money out. But there's a 5-year rule, right?
Mm-hmm.
What's that 5-year rule?
If you're not 59 and a half, you either have to be 59 and a half and have held it for 5 years. Mm-hmm. However,
there's some exceptions.
There's some exceptions to this.
Buying a house, if you have health expenses, if you're paying for health insurance, right? If you lost a job, I think you have to lose a job on that one too.
And the way distributions of Roths work is your basis, your contribution comes out first. Mm-hmm. So if you're only taking out the contribution part.
That we have 2 years ago. So I'm going to throw you off here, Jeff.
Okay.
They did it 2 years ago, so they're not within that they're still within the 5 years. Mm-hmm. Here, let me see if I can make my pen work. 2 years ago. So if you do it within 5 years, you're going to have to pay a 10% penalty unless you meet one of the exceptions. You would have to be using this for, I think you can do $10,000 for a house, or you can do it if you need health insurance. There's a few like emergency basis.
Education.
Yeah, there's a few little exceptions. Otherwise, what Jeff said is absolutely 100% true. If this was not a backdoor Roth, but you made a regular Roth contribution, you can always take that money out, and you never have to pay any sort of penalty on your contribution, no matter what. You would only have to pay the penalty on the earnings, and you're going to pay tax on the earnings too if you take it out of a Roth. But here we have the one weird exception, which is when you convert a traditional to a Roth, you have to wait 5 years to take that money out. So if they're only 2 years, they're going to get hit with that penalty. And yes, they already paid the tax on it.
Mm-hmm.
And you're going to have that 10-year penalty. If you are 59 and a half already, do you have the 5-year wait period?
I think you might. I'm not sure about that.
I think anytime you convert, you're going to have that little thing.
But in regards to your second question, no, Roths are not eligible for the 3-year distribution rule under CARES. That it only applies to traditional IRAs.
Yep. Somebody says if he has another Roth that's 5 years or older, would he still have to wait 5 years? Yeah, it's a 5-year rule on the conversion. So let's say that I convert every year. I do this every year. Then I can take back out the one that's 5 years older. Then I don't have to worry about the penalty. I can take that out. And remember, we're taking out the conversion only, not the earnings. When you do the earnings, you're going to have tax and potential penalty. You wouldn't have to worry about the penalty if you're over 59 and a half, but you would definitely have to worry about the tax. And then somebody says, can any traditional IRA be converted into a Roth IRA? Almost. The only one you can't is an inherited IRA from a non-spouse. And then can you also take money out of an education IRA and pay it back in 3 years? I believe so. It's somebody else's though, right? If I put in a Coverdale, they're talking about a Coverdale IRA.
Yeah, I'm not sure about the Coverdales, if they're covered under this as an IRA.
I think it's an educational IRA, but who's the beneficiary under Coverdale? I haven't messed around with them so much.
Yeah, we don't see them hardly at all, the Coverdales and the ESAs and the.
Yeah, Mina, shoot that in because we can get you the answer. I thought earnings in Roths aren't taxed because the contribution was already taxed, you'd think. But if you pull money out on the earnings were never taxed. As long as you meet certain minimal requirements, then my son is the beneficiary. Then the beneficiary, but the owner of the. So I think that they should be able to pull it out. If the question is who pulls it out, whether it's the child or the parent. The parent, if their child is under 18, I believe should have access. But we'll actually look it up for you. And then on a traditional Roth, if you take it out after 59 and a half.
Traditional Roth?
A Roth, a regular Roth IRA, you're going to be able to take the earnings out after 59 and a half, I believe, without worrying about any sort of tax, even on the earnings.
Right.
I may have misstated that a little bit earlier. If you're taking it out earlier, then we have to worry about the tax and the penalty. And there's two sides to that. So, and somebody says, if I take money from an inherited IRA under the CARES Act, can it be repaid to a regular IRA? You're asking some really interesting questions, guys. So you wouldn't be able to, if it's an inherited IRA, it's not your IRA.
Yeah, they made some changes to the inherited IRA rules under the Secure Act.
Yeah.
Which was back, January?
That was passed right in December.
Oh, December. Okay. Where I think the only thing they did on that is they extended the amount of time you had to distribute. I think they changed it from 5-year distribution rule to a 10-year.
10-year distribution rule. Right. And you can't put it out over somebody else's life. So
correct.
The
only
spousal inheritance you can put over the spouse's life.
So say you inherit your grandfather's IRA and he's already started taking RMDs, you can keep doing that.
You can do that or the 10 years.
Or the 10 years, correct.
Yep. So my father inherited that's something else. I always thought that was an IRA. So I don't believe you're going to be able to access the $100,000 under an inherited IRA because it's still the spouse. If it's an inherited spousal IRA, then it's your IRA.
Correct.
Then you can access that. Yes, you can.
Because it actually becomes your IRA.
Yep. How do we make backdoor Roth IRA? Are the IRA companies aware? Some are. So how do you do it? You literally make a contribution into an IRA and then you literally transfer it to another. So the custodian has to know what you're doing so they can do the proper paperwork. Yeah, and then somebody says, what about extending the 60-day to 3 years? It's actually, Jay, we don't have to worry about the 60 days. Under the CARES Act, if you take $100,000 out of your retirement plan, out of your, let's say, a traditional IRA, and you pay it back before the 31st, December 31st of 2022, it's treated as a trustee to trustee transfer, not a 60-day. So, and then you just said it was inherited. If it's an inherited IRA from a spouse or from somebody, a non-spouse. So Jay's going to answer that, and then Jay's sister. Oh, I'm so sorry, man. So if it's from a sister, then I don't believe you'd even be able to access the CARES. But again, these are really good questions.
Yeah, the problem with the inherited IRA from a non-spouse is you can't put that money back into anything.
No, it's not yours.
Anything that gets distributed has to stay in your pocket. Well.
Yep. And somebody says backdoor is a conversion from a traditional to a Roth. It's a conversion where you could not normally put money into the Roth. And so, yes, it's a conversion from a traditional to a Roth because you can always put money into a traditional. It just may not be tax deductible. You convert it to a Roth. You didn't take a deduction anyway. So you just managed to get money into a Roth that you weren't eligible to just put directly into the Roth. And then Jay and Mina, if you guys could email me those, or Patty or Susan, if you could grab those, I want to make sure that we are getting answers on those because those are novel, interesting questions. And we like to see somebody agrees with me and somebody anyway, so we'll make sure that we get it. So Q&A. So we have a whole bunch of questions still coming in. You guys love. So do we avoid taxes totally by doing a backdoor? No, because you're paying tax on the money that's going in. It's just like putting it into a Roth, but you're not allowed to put it into a Roth, and this is the way that we get around that rule. For kids, Roth IRA, in which ways can they use it for college, or they wait for their own retirement? No, they can. You can always pull out. So let's say that I'll use my daughter as an example. Daughter just graduated from college last year. If you guys listen to me, you know, she's been putting money into a Roth IRA for years since she was old enough to work. And that's a great savings account. If she ever needs the money, she can literally take any money that's put into that account back out of it with no penalty. It's the earnings that would subject her to the penalty. So that's what she always has to be cognizant of. So I always say, look, if you want a savings account, you want to, something where if you're in a real bad spot, you need cash, or you have a great investment opportunity, the Roth IRA is a great savings vehicle. It's a great savings account for somebody. All right. We have lots of questions, and somehow it's already 3:36. How'd that happen? All right. If I have a loss in my S-Corp in 2019 and 2020 from a 1244 stock, can I carry it back to recoup taxes paid on my personal 1040s from 2014 to 2018?
That's an interesting question. S corporations can have 1244 stock. However, the loss you can deduct is your basis in that stock. Unfortunately, when you're taking losses from 14, 15, 16, 17, and 18, you're already recognizing those losses on your 1040. So I'll give you an example. You put $100,000 into stock with an S corporation. You spend every penny of it, and at the end of the year, you have zero left in your S corporation.
Mm-hmm.
You're going to take $100,000 loss on your 1040 for the.
But you could do that as a net operating loss too, right?
Correct.
Yeah. So 1244. A bunch of people are asking, what's 1244 stock? 1244 is a fancy way of saying it's small business stock. It's less than a certain dollar amount. Is it $1 million? $1 million
Yes.
of capitalization?
$1 million of capitalization.
And 5 or fewer shareholders. So it's basically a definition that allows you to take your loss as ordinary loss on your 1040.
And you have to be the original shareholder.
You have to be the original issue, original shareholder. So it's, in other words, you can't have purchased it from somebody else. It has to be from the company itself. And you have limitations on how much you can put into the company and how many shareholders it has. The CARES Act that allows you to carry back the loss is for net operating losses. So if you take a 1244 stock loss, you can't carry it back. If you lose money in the S-Corp, but in 1244 is when you liquidate the company. But so basically, let's say you set up a C-Corp or an S-Corp, either one works. And like Jeff says, you put in $100,000, and after a year, you can't win. So you shut the company down. You'd be able to take that loss, even if it was in a C-Corp. You'd be able to take that loss and use it against your W-2 income or any other money that you make. It's just an ordinary loss, but it is not a net operating loss underneath the CARES Act. So if you do the 1244, and like you're saying, I have a loss in my S-Corp from 2019 and 2020 from 1244 stock, what that's telling me is it's not really 1244 that we're worried about. You just have operating losses. And if you have operating losses in 2019, you can carry them back to 2014.
Right.
And once you use up 2014, then you go to 2015. Once you use up 2015, then you go to 2016. And this is offsetting all your other income sources. So this can be pretty potent for you. So let's just pretend that you didn't say 1244, because that's only relevant if we are liquidating the company, right? Does that even have a place in here?
Not really.
2 years, like you can't have 2 years of 1244 loss on the same company.
Basically, the stock needs to be considered worthless.
Yep. But you can only do that once.
Correct.
So the S-Corp is operating loss. The 1244 is from a separate C-Corp that we closed. So there we go. We got the asker out there responding. So the S-Corp you can carry back. The C-Corp is just an ordinary loss that you would use to offset your income and then carry it forward.
Now, here's the ugly news on the S corporations. If the S corporation owns 1244 stock, it cannot pass that loss on to its shareholders.
Oh, he has 2 companies.
Right. So if the S corporation owns the C corporation and C corporation has 1244 loss, that S corporation cannot pass that loss on. Partnerships work differently. Partnerships can pass it on to the partners, but S corps cannot pass it on to the shareholders.
You are such a nerdy McGurdy.
I know.
All right. Somebody says here, you guys hate it when I answer questions with the questions, like I don't know how to say this. If I'm answering questions that are being chatted in, you guys always yell at me when I have the other question up. So I have this little Q&A thing. Look at how cute that is. All right, here's some of the questions. It says, regarding the CARES Act, where there's no penalty for IRA withdrawal up to $100,000, do we report income over 3 years? Do we report 1/3 each year? So, Jolie, the answer is the IRS wants you to report it 1/3 each year or $100,000 in year 1. Our position is that's kind of stupid because they're using the Katrina Act language and they're trying to apply that to the language that is under the CARES Act, which is different. But what's the penalty In other words, what they want you to do is recognize the income over 3 years and then file an amended return for 2 of those years.
Yeah, this was a part of that CARES Act that the IRS was really in a no-win situation. So if you're planning, you have 3 years to pay it back, but they want you to start paying taxes on it in year 1. So if you do pay it back by year 3, then you have to go back and amend year 1 return, year 2 return.
That's dumb.
Now, if we do it the opposite way and say my intention is to repay this loan,
then there's no tax ever.
There's no tax as long as I get it repaid by year 3. If something happens and I don't repay it, then I'm going to have to go back and amend year 1, year 2.
You would have owed the tax in year 1, and would there be penalties and interest?
There would probably be an underpayment penalty, not the IRA penalty, just the underpayment penalty.
I know, it's just weird.
Yeah,
because it's treated as a trustee to trustee transfer, so it would actually be, it would be non-taxable from inception. So I just look at that and go, wait a second, I never had the income in the first place. You literally take the income away. So how could there be an underpayment penalty?
It would have been much better if the act had been written that you have to pay it in year 3.
I think the IRS is wacky tobacco. And remember, this is written guidance from the IRS. This isn't the law. The law is the CARES Act. And it says ratably over 3 years, which God knows what that means. So if they had wanted it spread out, they would have said you include it pro rata over the 3 years, or you include the income in year 1. Like they actually said that in the Katrina Act, which is why I think it's just weird. Somebody says, what's the best place to donate a car? Any local charity that'll take it. Cars for Kids is always on the radio, but I'm always assuming that if they're advertising that most of the money is going to the overhead. So maybe somebody would want it if it's a good car. I used to give them to local rotaries and stuff like that, and they would auction them off. Mm-hmm. So I'd buy them at auction. Very good. Some of you guys know I was a liquidator growing up. That's where I learned business. And so we buy all these cars, and then sometimes you give them away. It's your basis in the car, but you're giving them to cool places where they're going to be able to make a bunch of money. So I kind of like that. Somebody says, somebody's asking the same thing. Is if I donate my car, how much can I deduct on my tax return? Full market value, what do I do? Usually you can do, if it's $500, I don't think you have to worry.
Right.
If it's more than 500, then I think they actually look at what you sold it for, right?
Yeah, there's 2 rules. The first one, the most common one you're going to deal with is what the nonprofit sold it for. That's going to be your deduction. Mm-hmm. So if it's sold at auction for $3,000, they're going to give you, I think it's a 1099-H or something like that. They'll give you a tax form that tells you how much your deduction is. If they keep the vehicle, then you're in kind of weird ground where you have to figure out what the actual fair market value of the vehicle is and what they're using it for.
Look at that one. You're still showing the Q&A screen. Yes, because I'm answering the questions that are being asked live. I just said that. I'm going to go just beat my head against the wall today. Can you tell me a couple of really good strategies to quickly recover the tax benefits from capital losses? I have a sizable amount of loss and I want to recover sooner than later.
What do you got, Toby?
If you have capital losses, you have to have capital gains.
Capital losses have been the bane since.
Yep.
I saw it in '87 with the crash, in 2001, and again in 2007. Mm-hmm. People carrying hundreds of thousands of dollars of capital losses on their books. Mm-hmm. That you got to have capital gain to get rid of it.
You got to have capital gain. Now, here's the thing: this is one thing that really irks me, because I've had people that will have capital losses that they're carrying forward. We had somebody, had 7 figures of capital losses, and they had lots of companies stock that had gone up in value, and they were afraid to sell them because they're like, I don't want to pay any capital gains on it. I'm like, you are not going to, mm-hmm. because you have all this capital loss. Just sell your company and buy it right back. And then somebody always comes up and says, what about the wash sale rule? And it's like, the wash sale is for losses only. So here it is. Let's say that I have $10 of capital loss, and I bought a share of company X for $1, and now it's worth 11. So I have $10 of gain. Let's say my loss was long-term capital loss. It doesn't matter. It's still capital loss. And let's say that the company I bought just a month ago. And it's getting to the end of the year, and I say, man, this is great. If I don't sell company X and then buy it right back, I am crazy, because I could just sell company X for $11, buy it right back. I now have $10 of capital gain that I don't have to pay tax on because I have $10 of capital loss. Somebody's, I'm going to quit reading the chat.
And you know what? I've seen people become emotionally attached to securities. That it's always made me great money and all, and that's great. Sell it today, buy it back tomorrow.
Yep. And you literally, not even today and tomorrow, you could just sell it and buy it right back. You don't have to.
That's true.
I could wait 10 seconds and buy it right back. So the best way to quickly recover tax benefits from capital loss is to make capital gains. If you do not, you're going to lose it. It's literally going to go away.
And I'll throw one in that I've seen is people holding on to investment property that's not really making them any money, but they could sell the property at a profit, walk away with cash and not pay any tax on it because they have these capital losses.
Yep. And the other thing is you just go find a relative, right? And say, hey, I have a bunch of capital loss. And if you're never going to make capital gain, have them give you something that has capital gain. So like if Jeff gave it to me, I could sell it, right? I'm going to get your basis and I could sell it. I could use it my capital loss and I could gift it back to you.
We're going to talk about 1031 exchanges a little later, but that is also one time if you're planning on 1031, but you got significant capital losses.
Then don't do the 1031.
Don't do the 1031.
We want to step up our basis.
Step up our basis and get rid of some of that capital loss.
Yep. And let's see. Do you guys still have to pay the? All right. If I become 59 and a half by 2022, in which I'm able to make a penalty-free withdrawal from retirement plan, do I still have to repay the $100,000? So you're penalty-free, you're never going to pay the 10%. So Marvin, I think this is on the, let's say you take $100,000 out of a traditional IRA, because it's only for traditional plans. It's not for your Roth. The only amount that we have to worry about is the actual tax on it. You will never have a penalty on that early withdrawal. It is exempt from the 10% penalty. If you choose to just pay the tax on it, you can. If you're going to hit 59 and a half, you didn't pay the 10% penalty anyway. You paid the tax. So there's absolutely no difference.
So if he actually takes the distribution though in 2020, but it's only 57 and a half, is IRS going to look at that as though that was a 2020 distribution that you did not put back into your IRA, and that will get hit with a penalty?
Nope, there's no penalty whatsoever.
Oh, that's true.
So you're just going to have the income tax. So you just spread the income tax over 3 years. So let's say you're not going to pay it back and you say, hey, I don't want to pay it back. Well, spread, let's say you take $90,000. You would pay $30,000 of income this year in 2020. You'd pay $30,000 of income in 2021. And you'd pay $30,000 of income in 2022, you would have 10% penalty for early withdrawal. It's great. Somebody says, I am trying to decide on the PPP loan by Thursday. We just have to decide which is best for me. Elliot, you're waiting a little late, but it's actually pretty easy. You're looking to see whether or not, and basically the reason that this is an issue is because if you take a PPP loan, you lose the employee retention tax credit, which is up to $5,000 per employee. So the way I look at it is, A, do I really need the cash? If I do, then take the PPP loan and survive. If I don't necessarily, like I'm not dying, like I won't go out of business, but it's going to be painful, then I would say, how do I need these employees right now? Or am I just basically paying them glorified unemployment? Because then I would look at the total benefit. So if I take $100,000 under PPP and I have 20 employees, but I can't get any of that $100,000 forgiven, or I get a small amount, let's say I get $20,000 forgiven, then my total net benefit to me is 20 grand under the PPP. But if I have 20 employees that I'll end up hiring by the end of the year, and I've been forced to shut down, and my income's been slashed in half, I could get $5,000 per employee. And if I'm going to hire them back at the end of the year, like during the holiday rush, I could get up to $100,000 of benefit. So 20 versus 100, I'm taking the 100. So it really depends on your scenario. So somebody says, what if the intention is to pay it back? How is it tracked? It's actually a tax document. There's a number for it, but they haven't issued it yet. And do this taxes, are they paid over a 3-year period? If you pay it back, no. That's the weird thing, is they're saying pay tax on it, but then you would go and amend your return. We're looking at it saying, I doubt I would ever even tell the IRS. You know, we have to make sure that you don't get hit with a penalty. I don't see how you get hit with a penalty if it's treated as a trustee to trustee transfer, but the IRS is being weird. I would argue that all day long.
Yeah, the only thing I could see could happen is if they decided that the 1099-R that reports distributions have to be issued each year, and I don't see that happening.
Got to go back to this just because I'm answering questions and somebody's going to yell at me. Yeah, here we go. You guys are asking a lot of good questions online, and there's some really cool ones, so we'll get to those in. I confused his heck. Carlos. What if the intention is to pay it back? How is it tracked? Yeah, Carlos, you should be a little bit confused because the IRS is confused. What I would do is, if you need the money, take it. Worst case scenario, worst case is next year in April, you decide to recognize 1/3 of it as income on your 2020 return.
And a big part of this decision is, if I take this money out, am I going to be able to put it back? If not, am I willing to pay the tax on it?
Yep. I'm going to put it all back in that, and I'm not going to tell anybody. That's the way I am.
Yeah,
I want to make sure
that's why you roll.
Right. And I would argue that all day long. I think that the intent from Congress, and I think Congress has made it clear, is it's liquidity. They're giving you access to money. It doesn't make sense to charge you tax on the money that they give you. Somebody asked, we always give a replay of this, by the way, guys, so you can always come back and watch. Some people just got in late. All right, my wife is 60. In 2019, she had $13,200 of Social Security income and 0 earned from income from work. Can she contribute to her health savings account for 2019?
First off, she does have to have a high deductible health plan to be able to make contributions to her health savings account. I'm assuming you're filing jointly. So somebody is going to have earned income to make this reasonable. If both of you are just collecting Social Security, I actually feel like putting money into an HSA is a waste, because there's no deduction.
I don't think you can. Like, first off, you have to have earned income.
Now, actually, you don't have to have earned income for an HSA.
You can just dump it in.
You can just dump it in.
Well, the husband could dump it in, but I believe that once you start taking Social Security, that it's either Social Security or Medicare that you're not able to do. You can't do HSA anymore.
No, really?
Yeah, there is a weird rule. See, now I want to go look it up. But I'm pretty sure that if you have the HSA, that you cannot do an HSA if you start receiving. So let's see, don't need earned income for HSA. Do you do for, yep, Jeff, you're absolutely 100% right. Both Jeffs, somebody's doing that too. But if you're a husband and wife, then one spouse could contribute. And then
right to a family HSA.
Yep. Somebody says, no, you can't do an HSA after Medicare. So there. So,
okay. But she's too young to collect Medicare.
She is too young to collect Medicare, but she's getting Social Security. So what I would be doing is I'd be contributing the husband's income. The other one so when I first read this, I remember my brain was doing Roth and HSA, and I ran away from the computer, so I wasn't looking at it. But the other one is you can make spousal Roth. This was just completely as an aside. I remember just walking right going, hey, there's that. Was that HSA or was it a Roth that he was talking about? And I just remember you can always do a spousal contribution if somebody has 0 earned income. So some of you guys are like, hey, it's only earned income for IRAs. Well, you don't even have to have that if you have a spouse. They can actually contribute on your behalf.
Personally, for me, if there's no tax benefit to it, I'm probably not doing it because HSA accounts tend to pay terrible
I can
earnings.
still use it against me, though. So I can make a contribution, a Roth contribution. Yeah, I see what you're saying. I see what you're saying. Pardona.
It's okay, Toby.
What is considered a high deductible plan?
I don't know. I cannot remember what it is right now. I want to say $6,000 is considered high deductible.
Let's see. It changes every year. The high deductible limit right now is the plan deductible at least $1,400 for an individual and $2,800 for a family. And can't be more than $6,750 for an individual or $13,500 for a family. So it's kind of a 2020. The IRS defines high deductible healthcare plan at least $1,400 for an individual, $2,800 for a family, and total yearly out-of-pocket expenses, including deductibles, co-payment, and co-insurance, can't be more than $6,900 for an individual or $3,800 for a family. So you have to look at both. So you have to be somewhere within that realm. All right. So somebody says, I would like clarification on the 401k withdrawal from CARES. You could actually do different ways to get money out of the individual. I thought HSA, but you could do a family HSA. Somebody's asking this. I don't want to get into all this other stuff. I'm going to go round and round. All right, we're already at 4 o'clock, so I want to knock out some of these questions. So I started my own cruise agency mid-February. Sales were strong, but then COVID-19 arrived. Everything stopped, and the industry experts believed in and now takes 6 months to a year to rebound. Actually, the bookings for cruises have never been higher after, like it's kind of weird, but I think it's all getting pushed out.
Caribbeans are up 400%.
Yeah, so it's kind of freakish. So hopefully you see some bounce back. I applied for the federal stimulus $10,000 funds, but I've not received a response. So that sounds like the EIDL plan, the economic injury disaster loan, and you're not going to get the $10,000 unless you have employees. You'd have to have 10 employees to get $10,000 of the advanced emergency grant.
Correct.
And that's, again, the SBA being, like, they imposed that rule. That's not what Congress said. Congress said you're supposed to get this money within 72 hours. And if you applied before April 16th, you should have received your money by now. Just the emergency grant. They still haven't done loans on hardly any of them.
And I believe EIDL is still closed to everybody but agriculture.
Agriculture is the only one they opened it up for. So it's absolutely a dumpster fire, which you've probably heard me say that many times before. When they came out, I said, I don't know how the SBA is going to do this. They're not equipped. I thought they were going to outsource it, but they didn't. So they're just not doing it.
Nevada announced this morning that they're going to bring in people who used to work on unemployment because they are so terribly far behind.
Right. Somebody says, I applied before 4/15 and have not heard anything. Carlos, you should have received by now. We are getting, actually, we could probably go back to the dates. They are working through everybody who applied before the first CARES Act was done. So you should be hearing something anytime. The way you know is they hit your credit, and then the next day or the day after you receive the funds, and it's based off the total number of employees.
So you'll see an inquiry on your credit, or
yep, you see it's Experian is who they're using. Somebody says, I have tried many times to file for unemployment, no success. That is so frustrating, and just keep trying because you're going to be entitled if you are operating as a sole proprietor. If you are operating as a corporation, then it depends on whether you are taking any salary. And by the way, if you started your cruise agency before February 15th, you're eligible for EIDL. You're eligible for PPP. But if it's after that, I don't think you'd be eligible. So that may be a part of the problem. If you are a sole proprietor or if you are an employee of your S-Corp, you'd be eligible for unemployment, is so long as the S-Corp was actually paying in. It's going to, I think there's 2 states where you're not. Most states allow you to be eligible if you were paying state unemployment. And then the $1,200 check, you would go and you would look. There's something on the IRS site. I forget what it's called, but I don't know. What is that called?
I cannot remember.
There's something like check my payment or check my stimulus.
If you look up like where's my stimulus payment, you'll probably find it.
You'll find it.
Even though you haven't filed 2019, as long as you filed 2018 and met the income limitations, you should be getting the $1,200
It's
check.
called Get My Payment. There we go. Other than that, what I'd be looking at is grants in your local area, and also with your with your local business associations. Some are doing some emergency grants. I'd be talking to your bank. I doubt that you're going to be qualified. You're not going to be qualified under the Main Street program, and it's really, really tough. Other things I'd be doing is looking at alternative lenders. What's going on right now is most banks are only concerned about PPP loans. So that's leaving a big void for lenders. And if you go to some of the fintech folks and some of the alternative lenders who are having some success on other types of loans, the other thing you could do is it's expensive, but there are ways to get access to funds if you use your personal credit as like personal credit cards and doing cash advance. So like, I hate to tell you that you can go that route, but they charge you like 10-15%.
Yep.
So I wish we could be more helpful on that one. What is the best way to set up a real estate LLC if you're an investor that does both buy and hold and flips? Yeah, I've been getting hit hard.
My first thought on this was I would split them. I would not have my buy and holds with my flips. I'd probably run flips through a C corporation, something that doesn't pass it through to me personally, and keep my buy and holds either in an LLC in my personal name or a partnership or some pass-through entity.
And you are absolutely right. What you need to do when you're an investor is you separate it out so it goes onto your personal tax return on your Schedule E. In your flips, you're either going to be doing that through an S-Corp or a C-Corp or an LLC taxed as an S-Corp or a C-Corp. I'm just going to make it really simple for you. This is how 99.9% of the time you do that, because fix and flips are an active trader business, and a investor is a flow through that should go right onto your and that should go right onto your personal tax return. It's going to go on either page 1 if it's a disregarded LLC of your Schedule E, or page 2 if it's going through a partnership. And yes, your schedule, your S-Corp will go through on a K1 on page 2 of your Schedule E also. Right. So it all ends up, if you're using an S-Corp or a partnership or disregarded onto your return, the only time that you're doing a C-Corp for fix and flips is if you want to keep that income off of your return, or you're going to zero it out. So this is kind of fun, by the way, but that's the way you do it. From an asset protection standpoint, works like a charm. From a tax standpoint, it's the way you have to do it, because if you're mixing them, the IRS doesn't know what you are, and it's more than likely it's going to treat you as a trader business, which means you lose the ability to do installment sales, you lose the ability to do a 1031, use the ability, you're going to have a self-employment tax on it. What else do we lose? And it's all mixed up. So you don't get long-term capital gains. You just have some bad stuff that happens. So I want to make sure that we separate those things out. So one's a trader business, one is an investment. We keep those things completely separate. I know I'm zipping through these guys because it is, I know we have a lot of questions. We will get back to you guys asking.
We only got 8 hours till midnight, got a lot to get done.
Somebody says, if I pull equity from a house, does money need to go back into the house, or can I use it on another property or for other things?
Well, you can use it for whatever you want. However, you're probably talking about deducting the interest.
What if it goes on your Schedule A?
Right. So if you use it for something other than your house, buy, build, improve, it's not going to be mortgage interest on your principal residence. However, if you use it for investment property, something like that, you buy a rental property, you can deduct it over on that investment property.
Yep. In fact, that's one of the workarounds is if you are pulling money out of your house and right now the Tax Cut and Jobs Act limited your interest deduction to mortgage for acquisition indebtedness on a house.
Mm-hmm.
Which just means you used it on your house, your residence. You can write off for your personal residence or a secondary residence, right? You can write that off on your Schedule A so long as it exceeds your standard deduction. And when you look at your Schedule A, like you would never write off your mortgage interest if your Schedule A is below the standard deduction. You're always going to take whichever's higher.
Mm-hmm.
And then they say, but it has to be used for acquisition indebtedness, which means if I pull money out of my house and use it to pay for my kids' college, I cannot write that off. Because on my Schedule A. Now, what Jeff said is 100% accurate, which is if I pull that money out and I put it into an investment property and I pay for the kids' college through some other funds, I can write off the money I pulled out and used for my kids and used for the investment property because it'll be on your Schedule E. I'm still getting this weird audio note. Please close any unused internet applications. I'm just gonna pretend like it's not notifying me with big red lights.
I'm sure they can hear us because they keep asking questions.
Yep. I don't know what it is. Sometimes I get mad at Citrix. So if you're pulling it out of your house, what I would do is I would reach out to us and make sure that we are that we are being as clear as possible. Also reading a bunch of questions that are popping in. Hey, I'm just going to answer somebody's question about the loans. All right, there's two types of loans under the SBA program that are time critical. Number one is the PPP. Number two is the economic injury disaster loan. The PPPs are going full steam ahead right now. In fact, there's probably another 120 billion waiting, and people are sitting back on them because of the ability to write it off. People did not realize that they would not get forgiveness. So they're like, oh man. So the PPPs we're getting approvals for, in some cases, same day, some cases 2 days. Some cases, it just depends on lenders. We apply at multiple places because you never know who's going to say, yes, I'm taking more. So we're walking through as many doors as we can to get that magic E-Tran number, which is when somebody gets an approval with the SBA. The EIDLs, we have been getting approvals on the ones applied before April 16th, but we cannot get status from the SBA. We used to be able to, and then they just shut it down. They sent emails out to everybody. So if you did an EIDL loan or an economic injury disaster loan, however you want to take it, it stinkolas right now. We cannot get to anybody with the SBA. You can call them and they're going to say, hey, we don't know. We had approvals from April. I'm thinking one that just pops off my head was like April 7th. That approved and had the loan approved, yet they've not sent out the email. What they're doing is they're working through the backlog, and God knows how they're doing it. So we've had approvals for people going all the way up until the last day of the applications before they shut it down, which was April 16th. And we have people that applied previously that have not been approved. So it's just, you got to watch your account. They're gonna hit your credit. They're gonna do it. They were supposed to do it in 72 hours, but they haven't. And the what is it? The office. What is the ones that audits the?
Not G&A.
Somebody just went through and they looked at it and said that they weren't doing what they were supposed to be doing.
Right.
So, but we knew that from the word go because they did as many loans in 2 weeks as they had in the previous 10 years combined. Actually,
I think it was the GAO that did it.
GAO did it, Government Accountability Office. You're absolutely 100% correct. And they basically said SBA is not giving guidance. The SBA is not doing what it's supposed to. It's not responding. It's all this stuff. But what are we supposed to do? This is an organization that did tens of thousands of loans a year that's now been forced to do tens of millions of loans. And what do you expect? It wasn't set up to function. They gave it more money, but God knows, trying to scale up in this economy right now, they're probably having the same trouble we are. You can't get people to work because they're all taking their unemployment when they get it, and they're afraid to go back to work because it took them so long to get unemployment in the first place. So we really do have kind of a ridiculous situation. Can we write off donations to our nonprofit, even though we still have not been approved for that 501c3 status yet? The answer is yes. Your 501c3 actually has 27 months to get approval on its application from the date that it actually started the company, or actually for when it first applied. Actually,
From when they first send in their application.
Yeah, so you have plenty of time, and yes, you can write off your donation. It's very commonplace for someone to set up their nonprofit at the end of the year. In fact, we had people actually that would set up, write the check, and actually get the application in a month later. But since they set up their company and wrote the check to the charity, even before its bank account was open, before the end of the year, the IRS applies it to the year that you wrote the check, as long as it's set up within a few days. Or literally it's 2 weeks, although we've never had a contest on it, but they always say, yeah, we're fine. Is it too late to apply for a PPP loan for a contract worker? No, Jesse, it's not too late, and you want to jump on it as quickly as possible. What I will say is we're having a ton of success with our lenders. We're using some fintechs. We're using some local banks. If you want to talk to us, we're happy to help. If you are just like, hey, it's a small amount, go to your local bank. I filed 2019 taxes too late, and the IRS used my 2018, which was too high. Can I call someone to see if they will use the 2019 return? This is for the stimulus.
Right.
You can still file the 2019, and you will get the money. More than likely, it'll be a paper check.
Yeah.
So you will get it. It'll be this summer. It's kind of crazy. Somebody says, I missed the webinar on Saturday for tax and asset protection workshop. How can I watch the material again? So we did a one-day tax and asset protection event on Saturday. If you want to get the replay, I have no problem with you guys getting it shared out. We will be teaching one again in June. I just don't know what date. Actually, I think we're going to be doing one that's focused on residential assisted living. So I'll just be real clear with you guys. You probably want to get this material. Happy to share it out. I don't think we've offered it, but we've been teaching a lot of live stream events that are broadcasted out. Here, before I go there, somebody else says, is the stimulus check retroactive for people if they file their 2019? Yes. Yeah, you guys asked almost the same question, two different people. How long will the stimulus checks be available to the public? Until the end of the year, right?
Yeah.
And then
the plan is all the way through December 31st.
Yeah, so if you guys want to get access to the tax and asset protection event we just taught, it's a one-day. I don't know if Susan, if you're out there, then can you make yourself heard? Because we can have this conversation on the fly. If these guys want it, I have no problem sharing it out if you have it. If you have it as a link, you tell me.
I do not have it as a link, but they can email events@andersonadvisors.com, and one of our event advisors will get the copy for them.
So you guys can send it to events if you can read my writing, or you can just post it in the chat. AndersonAdvisors.com. Look at that. I can't write from crud. And I can barely even read that. What's that?
Yeah.
Upcoming date?
June 18th.
Oh, June 18th. That's in Austin, Texas. I don't know if we're going to be open for that. So I don't think so. Here's what's going on with the live events, guys, because we love teaching live. You guys know me. I'm a chatty Cathy. I'll come out and talk to anybody. Is they are putting one person for every 6-foot table. So you're going to have to basically have a stadium to talk to a group of 100 people. So it's like something ridiculous. So we'll make sure that we get it out to you guys. Hey, Patty, if you could send it out to just everybody. I don't know how to do it. I'm not smart enough. All right. I own a dental practice. I am purchasing a new commercial building through a new LLC to add a new location and then rent it back to the business, which operates as an S-Corp, which is perfect. The building purchase will be cheaper than the rehab. With the new CARES Act changes, what are the best tax benefits for this situation? So first off, if you buy a property and then do qualified improvement, you can write that off over 15 years. Or you could accelerate that depreciation by making a 3115 election, right? So we would treat it as bonus depreciation and write it all off in year one. And here's where it's beneficial to the S-Corp. If you are self-renting, you can treat your dental practice and the property as one activity. So it's called grouping. And you group the active trader business with the rental property to it, and you can take the losses from your rental property and use it to offset your S corporation income. This is the exception to the rule. There's basically two exceptions. Exception number one is being a real estate professional. Exception number two is grouping an active business that is self-renting, so long as the ownership is identical and you're renting it back to your own active trader business. Then they will group your rental activity as that trader business, and we will bring it all in. Now, in order to make this work, you're going to need to do a cost segregation. I think you have to. Although I suppose you could just do the rehab, the qualified improvement property, and treat it as 15-year property, and then do a bonus. Just do an accounting change, but I would do the cost segregation on it.
You know, another way to do this is to have the dental practice actually do the rehabbing and the improvements.
Yeah, that's actually, I didn't even think about that. So you have the S-Corp. So somebody's saying this, does IDEA work with mixed use property if I operate by S-Corp from one of the available commercial spaces? What if it's only partial? Then the grouping might be for that portion of the building. I think it's usually you have to have the whole thing owned. Yeah,
you're going to end up having to segregate.
Yeah, but
the part you use from everything else.
Yeah, what you might end up doing again is having the S-Corp rent the whole thing and sublet out a portion of it. Sounds stupid, but it might be worth it. So, Lynn, that's something we should talk about. Anyway, so you're going to be able to write this off. This is going to be a huge benefit to you, by the way. And anybody out there, you could substitute in dental practice for any sort of business. When you rent to yourself, you're going to get a huge first-year benefit. Like the number will be on $1 million building, you're talking about a $300,000 loss in year one, on average. So by doing cost segregation. So you could absolutely get a nice big fat tax benefit. If you want good people for cost segs, I have a few folks I could send you to. You probably heard me. I just did a webinar with one, and then Eric over at Cost Seg Authority, but also Ivetson. There's some really good folks we can send you to. It depends on where you're located. So if you reach out to me and you say, hey, this is where I'm located, I could probably tie you in with somebody who knows what they're doing. Is it too late to do a cost seg in the 4th year of owning a building? No, it is not. It's whatever year you decide to do the cost seg, and then you change your accounting And I don't want to get too deep into this just because I know we're going long, but I always use carpet as the example. So if I'm in a commercial building like I am right now, Jeff's sitting right next to me, he's within 6 feet and he keeps coughing on me. So you're like, I don't know what you're trying to get at, man.
I need my 113 square feet of space.
We are 6 feet away from each other. No, but you have carpet and you have the structure of the building. Excuse me. The carpet isn't going to last 39 years. So the building is going to last 39 years. If I cost seg it, I can break out my carpet and the electric system and the lights and the panels in the ceiling and the cabinets and the walls. I can break all those out and write those all off right away. And so anyway, so that you can absolutely get like you could write that off and you could accelerate that depreciation in 1 year. And somebody says this to Joe living around me. These people are horrible. They're just shading us like crazy. But you can absolutely write that off either over 5, 7, 15 years, or you could just choose to do bonus depreciation on any of those items. I can take my 5-year property. I'm going to write it all off this year. Or my 15-year property, I'm going to write it all off this year, or I could spread it out over 15 years. You get to decide. Once you have those numbers, you're able to sit down and decide whether it's beneficial. When somebody says, clarifying, does grouping only work if ownership of the building and ownership of the active businesses are identical? Yes, it has to be the same ownership. So I know it kind of stinkholes.
Yep.
Gosh, we have so many questions. I'm trying to see. I have to read. Anyway, we're actually getting through them. We'll just go through. All right. Will there be a penalty forgiveness tax for paying an employee more than the average 2019 salary calculated on the PPP because of overtime or to catch up with pension plan payments, et cetera?
And the answer is no.
There's no penalty.
There's no penalty. It can actually help in your forgiveness calculation because, you're looking at me askew.
They said it has to be, you can't pay them more than the average.
No, was that just for owners or? I was thinking that was directed at owners.
It was directed directly at sole proprietors and anybody that has, because they actually, the question was, could I pay somebody in advance? So could I double up my payment?
Right.
In that 8, and they said it has to be the average. Now I don't know how they're going to know that.
Yeah, you can't prepay anything.
Yeah, but is there a penalty? No, there's no penalty. It's just I'll probably have to use their average amount to pay to use my forgiveness amount. Now it's up to you to do the certification, and I haven't even seen it.
I'm pretty sure that the certification is going to go through the lenders. So we don't know exactly what SBA is going to tell them that they have to collect. But I think we have another question that talks about actually what they're looking at for forgiveness.
I'm going to show you guys the exact rules. So you guys, it's going to come up here in a little bit. I have applied. Here's another one. Click. I have applied. This is a live question. I've applied for an EIDL loan, an EIDL loan. It was issued a confirmation number the 8th of April. I've not heard anything. Every time I call the SBA, they keep telling me as long as I haven't gotten a denial letter, I am good. They're just working through the backlog. Is there any way to find out what my status is? Vito, you are in the same boat as everybody else. And at least you got to apply for it. They haven't even opened it up for the second tranche, which is 6 times as big as the first tranche. So you're dealing with the SBA that is just overwhelmed. They do not have enough bodies. They need to outsource this. Write your congressman, and I'm not joking, guys. Write Munichen or anybody.
Mm-hmm.
Write your congressperson. Write your local SBA office, whatever, and just say, will you guys please kick this out to the lending institutions, pay somebody. I would actually give it to a fintech company and let them process it like a PayPal or somebody else that has systems that they could just program it out and get those funds out because it's ridiculous how long this has taken. And yeah, you're talking about loans that were applied for a month and a half had not been approved. And it's not that many. It's like, come on, this is ridiculous. It's a fraction of what the PPP was able to issue when you went to the banks. So, and Congress didn't make it any better the second time by dumping more money on the problem. You actually need it. I feel for you. We're in the same boat. We're looking for all sorts of other funds. We do that too. Somebody says, so my second home is free and clear. If I rent it to my LLC, any fixes expense can be deducted, right? Also, can I get home equity out on this second home for reinvest? So this sounds like somebody has a second house and they want to rent it so that they can write off the expenses on it. It's personal property if it's a second home. So renting it to yourself doesn't count. I'll make that easy.
Yeah.
So rent it to third parties, rent it for more than 14 days, and then make sure that you are using it for, what would it be? If you rent it for more than 14, and then you would get at least an apportionment on the expenses. You'd start dividing it up between personal and by the number of days that you use it. Somebody says, if the money from a 401k is taken out during the CARES Act, isn't that a loss due to the stock market? No, Grace, when you have money lost in a retirement plan, it doesn't do you any good. What you could do though is convert that into a Roth. So if you have money in a 401k and you have control of it, you may want to convert that to a Roth 401k inside your plan and roll that out to a Roth IRA and just convert it. And that way you will pay tax on the reduced amount, but you don't get to write off the loss. I'm just giving you a little way to do it. Somebody says, if you purchase vacant, unimproved land with the intent to build, develop homes for sale or rent within 1 or 3 years, what tax advantages can be taken? Are the LLC business expenses for it as well as interest taxes from the loan able to be included on Schedule E like a normal rental property?
So this is land that is intended to be developed, not rented, so it will not go on Schedule E.
Correctamundo.
Now, your LLC business expenses are always deductible. However, some of these other expenses like interest, taxes on the property, you really have to make a choice of where you're going to apply those. You can elect to capitalize them into the cost of the land, which is pretty prevalent, or you can elect to deduct them through the LLC. Interest is fine. The problem comes with taxes. It's what we call a separately stated item. It goes on Schedule A along with any other taxes you pay and may be limited due to the $10,000 limitation on taxes.
If you're going to develop land, wouldn't you just want to do it through a corp?
Yeah, I probably would. And I would probably be capitalizing all these expenses that are directly related to the land.
When he says capitalize, it means you don't get to deduct it now, but when you develop and sell, it's going to increase your basis.
Right.
And so you're going to get to write it off by not paying tax on the gain. But it's going to be ordinary income because this is not an investment. This is actually, when you start developing, you're going into the realm of an active trader business.
Correct.
So, so I'd be looking at it a little differently. Like I agree with Jeff. So this is not with when you say I'm with the intent to build, develop for sale. That's dealer activity. That is not investment. And then somebody says, what if the intent is to rent it? So I have rental land and I'm just renting it out, or I'm going to build something on it and rent it.
Here's the bad news here. It goes on Schedule E, but it comes right back off because rental of anything that is less than 60% depreciable is considered portfolio income, not rental income.
So will it even offset the rents that you're receiving?
No, I don't think it will because it's not considered passive anymore.
That's why people don't usually rent land. Usually, yeah. So there you go. So don't do that, right? So,
and here's the extra bad news.
What if we build on it? If we build on it, then we can depreciate the item that we built.
So let's say that he's renting out this vacant land. Somebody put a cell tower up or something.
Uh-huh.
He makes income. That income is portfolio income. He loses money on this rental. It's passive loss.
Mm-hmm.
It becomes the worst of both worlds.
Mm-hmm.
So you're talking about putting the building up on it. As long as we can reach that 40% depreciation amount, that 40% of the value is in depreciable property, then it changes its character back to rental.
You're going to get it as long as you build something on it.
Correct.
Into a rental property. So what Jeff is saying in non-tax English is build on that property. Don't just leave it as land, because when it's portfolio income, it's not.
It can't, like you said, it can't offset any of your passive losses.
Right. What Jeff said. All right. I own a C-Corp registered in Delaware with an extension in, it's foreign filed in California. I'm in the process of moving to Austin and would like to operate from Texas. What are the steps I need for moving from the C-Corp to Texas? Can your team help? Amar, what I would be doing is, you can keep it in Delaware and just can't, like what you do is in California, you'd have to do two things. A, you're going to file a final tax return with the franchise tax board as soon as you're out of there, so that they don't come looking for you in 5 years trying to hit you with an $800 a year franchise tax, because that's what they will do. Unless you actually cancel with them, they will follow you around forever, even if you're not there.
Yep.
Because they said, hey, you registered here once, you must be doing business here every year. It's the stupidest thing, right? The second thing you're going to do is cancel it with California, and then you can register it in Texas. If you want to just set it up in Texas, there's two ways to do it. Usually you just re-domesticate it. So you're going to convert it to Texas if Texas has that statute. I don't know off the top of my head. Or you set up a new C-Corp in Texas, and you transfer your shares of Delaware into Texas, and then you do what's called a reverse merger, where you merge the Delaware into the Texas. So the easiest is probably just to keep it in Delaware and register it as doing business in Texas. It's probably the easiest. All right, jumping on. Please don't come here, Eric. What's that? I must be, let's see. Texas is full. Please don't come here. They don't want to, I think Tesla's moving there. You got to be kidding me, Eric. You're going to have it. Let's see. I'm in my house for more than 25 years. It's time to make repairs. Can I write off repairs in my house? No, because it is no more California. That's horrible. Other people are saying welcome to Texas. So there's you got to figure out wherever Eric isn't, wherever Lee is, you're going to go there. No. So the question was, let's see if I could do this right. If I've lived in my house, it's personal property. You can't write off the repair expense on personal property, so you're not going to get any benefit for it. All right. So LLC owns mortgage notes. Can the LLC file for EIDL to recoup payment loss? So any LLC can file that was in business on February 15th can apply for an EIDL. You just can't do it right now because it's shut down, because when they ran out of money the first time, they closed it and they haven't reopened. But yes, you can still get it. And the way they calculate the EIDL amount, so I just tell you what we've seen. Number one, they'll give you $1,000 if you don't have employees or you have one employee. They just give you $1,000 under the emergency grant. They'll give you up to $1,000 per employee, up to 10 as an emergency grant. If you get a PPP, it comes off the forgiveness portion there. So there's some question as to how great that is. But if all you're doing is the EIDL loan, that's good. And then they're going to give you 1/2 of your gross profit, not your gross income, but your income minus your cost of goods sold. And that's what we've seen. They'll give you 50%. So those are on the loans that we've actually had done and seen, which again, they are trying to work their way through the backlog. It is hit or miss, and it's few and far between. All right. So what else do we have? Somebody says, I heard South Dakota is better protection than Wyoming. You heard wrong. South Dakota is great for asset protection trusts. They are ranked number 2 on the power rankings. They are almost as good as Nevada, simply because Nevada, the Asset Protection Trust protect you from child support and alimony. It's the only state to do so. Otherwise, South Dakota is great. But as far as protection with LLCs, Wyoming and Nevada have identical statutes. Wyoming doesn't list your name, just the incorporator. In Nevada, it lets you use a nominee. Wyoming is cheaper. Nevada is more expensive by a few $100 a year. So we are right now giving the push to Wyoming, but we like both Wyoming and Nevada. That's about as good as you can get. And if you want a bazooka, you get a Nevada Asset Protection Trust. But that again is that's a bazooka, and usually if you're you don't necessarily need that, and they're a little expensive to operate. And they're a little clunky. If you're just running a business and you just want really good asset protection, use an LLC in Wyoming. It's worth its weight in gold. If I was verified here, this is more questions that are being asked online. I'm just going to answer these real quick. If I was verified in EIDL and received the grant, do I need to reapply? No. They are still working through Lee. They'll end up getting to you and they'll give you your loan. So like I had one, it's a $500,000 loan that's been approved that we've been waiting on the paperwork forever. And I've talked to them. And again, we work on behalf of a lot of clients and it's just pounding your head against the wall. And they said they'll send you the email out when it gets to you. I had a client got $500,000 and there's no rhyme nor reason. They were done within days of each other. It's just the SBA. So I wish I could tell you that I had better news for you. We've done quite literally almost 1,000 of these, and it's all over the place. So just sit back and watch your email. I would type in sba.gov and see if you got anything in your spam too, because what they do is they email you the loan paperwork, and the verification is weak. That just freaks me out that they're giving money out without verifying even the number of employees. They'll just prosecute you if you lie. So it's kind of weird. Can a rental loss on Schedule E carryover be deducted by capital gain from property sale in the future, or deducted by any other passive income? So can the rental loss, so I have losses on Schedule E, that's a passive loss, be deducted by capital gain from the sale? No. So when you sell the property, that's disposal of a business asset and it's ordinary loss. So you don't have to worry about that. That ordinary loss will offset your other income. If you have capital gain, will the passive loss offset that capital gain?
Once you sell that property, the passive loss is no longer suspended.
And it gets used against.
It gets used, but
you could use it against anything, right?
Well, the passive loss is, it becomes non-passive.
And it becomes ordinary loss, and you can offset your W-2 with it as far as.
And also any gain on the sale of that asset is also considered passive. So you could use any gain from the sale of that asset to offset other passive losses.
So the answer is yes. And then.
Well, why didn't we just say that?
Because we're getting punchy, right? Oh, Jeff, you're going way long. All right. I used to work for New York State and had a 457B. I left the state job 5 years ago. Is there any way to withdraw all of the 457 funds? It's a state fund, right? I don't want the 457 amount to count towards the $100,000.
Yeah, I would think if you're no longer employed by the state, you should have the right to withdraw that money.
And I would roll that into a 401k. I'll just be real straight with you, because you could borrow out $100,000 and pay it back over 6 years, and I could take $100,000 out that I pay back in 3 years. One is an early withdrawal and one is a loan. So I'll just tell you, that's what I'd be doing if I was you. The 403B. That's
a charitable.
Is that for charitable?
That's charitable.
457, yeah, I guess, yeah. 403B is a charitable. So you can, it's up to your plan administrator if they're going to let you take the $100,000 early out, and it's up to your plan administrator if they're going to let you do a $100,000 loan. If you roll your 457 from a past employer into a 401k, you don't have that. You are the administrator.
And not every retirement plan has a loan provision set up in it.
Yep.
So you really need to talk to your plan administrator.
The numbers we've had back from the administrators associations for these big groups is about 60% of the plans are allowing you to do the early withdrawal, and about 60% are allowing you to do the $100,000 loan. But again, if you just roll it into your own, you don't have to worry about it. Can cost segregation, this is a online, and then I'll quit doing the online because we have to knock these things out. Can cost segregation of a new property count against the profit of selling other assets that failed through a 1031 exchange? So you have, so the answer is I have a 1031 exchange where I have the 1031 exchange. So if it's failed, then you just have capital gains and depreciation.
Right. It's like it never happened.
And then if I have cost segregation, that's going to create a passive loss. So if you're a real estate professional, I know the answer is yes. Would they still be able to do anything on cost seg on capital?
It could possibly change your gains and losses.
They had a failed 1031 exchange, so they're going to have capital gain.
Right.
And they're going to have depreciation recapture.
But if they did a cost seg on the old property,
beforehand,
they could have pulled some of that out into 1245 property.
I think they're doing after. But that's one that you email in and let's get some facts.
Yeah, if it was done after, you may need them to revise your numbers.
And then somebody else says, does early withdrawal apply to the TSP accounts? They still won't tell us. So the thrift savings plans, they've said that they're going to, but then they said they're going to give written guidance, but then they haven't. At least I looked yesterday and I hadn't seen it. And they've been saying that since the March 27th. So
and I think we're going to need guidance from TSP itself, what they're going to allow.
Yep, and that's what they keep saying they're going to do. It has nothing to do with the CARES Act. It has nothing to do with anybody other than TSP. And they keep saying they're going to decide.
We'll get back to you.
Yeah. So they're like, just hang on for a second, and then they wait a month and a half. All right. If I pay my home personal internet bill with the personal credit card and then pay the personal credit card with a business checking account, is this considered piercing the corporate veil? The answer is
not really. No,
it's not. That's fine.
I would actually do this a little differently. I would have the credit or the company reimburse me for my expenses on my credit card rather than paying the bill directly.
That's easier, but it's not going to hurt you to have the company, like as long as you're giving it an expense report and it says, hey, could you pay this? Then yes. I'm not going to answer it online. I'm looking.
I was about to say, Toby.
All right. If my C-Corp reimburses for vehicle mileage, how do I then do my personal and C-Corp taxes? If you have an accountable plan, which you will, if you have a C-Corp through Anderson, then what is it? It is 25 Code of Federal Regulations 162-2. I think it's 2-2. I can't remember. It's 162-2, I believe. That's the account where you have an accountable plan. Then you don't have to report it on your personal. So it's zero under a 1040, and it's a business expense under your 1120. I don't know why I'm doing that. 1120, it's just an ordinary and necessary 162 expense.
So my C-Corp gives me $100 for my vehicle mileage. C-Corp deducts $100. I don't add anything to my income.
Yep, it doesn't do anything. It's non-reported. That's why we like it. All right. Somebody says, I'm using a Series LLC. I'm a passive investor in apartments. So Series A has apartment 1, B has apartment 2. Each series has its own EIN. It's a single member LLC. So there is no K1. So I'm just going to say that's what I saw originally. If it's a single member, then there is no K1. So the fact that it's using your personal, I would still get an EIN, but it's not going to impact you at all. And so my question is, if a renter tries to sue me, would a good lawyer reach into these LLCs because the government associated my Social Security? No. I'll make it really simple for you. That's not going to be important at all. The question is going to be, did you pay for the series? Did you keep it compliant? Did you keep separate books and records? And did you commingle? All right. Can I write off passive loss with any taxable income under the CARES Act?
No.
The answer is no. passive loss, you write off. Go ahead.
The rules for passive losses haven't changed since 1987. So there's the couple things we've talked about in the past. The $25,000 rule for active real estate rentals under certain AGI.
Yeah.
The real estate professional has different rules, but the CARES Act did not change any of that.
So I'm just going to say, if you're under $100,000 W-2, then you can do this 25,000 and it phases out in the next 50,000. So if you're like 125,000, you're going to get half of it. You're going to get a $12,500 passive loss against your active income, or what's called a real estate professional. Otherwise, no. Real estate passive losses do not offset.
You have to have passive gain to offset passive losses.
Yep. And stock is capital, so yeah, it doesn't work. Or W-2 is active. So yeah. So keep paying attention to us. What is the PPP forgiveness criteria? I know a lot of you guys were asking about this. This is it. Is it over the 8 weeks? So it's 8 weeks after you get the money, and they give you that money. You have 8 weeks from that day, and it's whatever you spend on payroll costs, interest on any covered mortgages. So it's the interest for that period. So you can't prepay a year, but it's payroll costs and any payment to cover rent or utilities. They add all that up, and payroll costs, by the way, that includes health and retirement benefits that are paid, employer paid retirement benefits and employer paid healthcare costs. So the only thing that is capped is up to $100,000 annual wages. So you get up to $8,333 per month. So you multiply that by 2, plus any retirement plan contributions by the employer, plus any healthcare group plans by the employer. You add all that up, and then you reduce it by this proportionality, the average number of full-time equivalent employees,
which they still have not defined. We're assuming it's going to be 40 hours, but it could be anywhere between 32 and 40.
I think they gave us written guidance on that.
Last I saw, there was no guidance on that.
It's in an FAQ, I think,
okay,
where they said the equivalents, but I believe I may be stretching it. I thought, like, if you have a 30-hour employee is full-time, and then if you have like 2 employees doing
20 hours each, I would assume that would also be
full-time. So I think that's what they said, but I may be completely wrong. I may be thinking of something else, but I believe they did. And then the SBA created this weird 75-25 split, with 75 being salary, 25 being non-salary, and Congress is ticked about it. Can I use 100% of my PPP loan forgiveness towards payroll? Yes. You just have to make sure that you're keeping in order to get 100%, you have to have the 100% of the number of full-time equivalent employees. So you need to hire people before June 30th, or you need to try to hire back your staff with a written offer to come back, so that if they reject you, they still get counted as an employee. And then even before this whole virus situation hit, we had a few tenants who skipped town early on their lease while owing back rent. So the total amount in this case, for example, is 2 months. I'll make this really easy. What do we have to do in order to claim this as a loss? You would have to recognize it as income, which you're not going to do. In either way, then you'd say the loss minus the loss would equal 0, or you just don't recognize it as income, in which case you don't get the loss, which gets you to 0 too. So I'll make that really easy. You don't get a loss. You only get to write off the actual hard expenses associated with that. So it sucks when a tenant skips town on rent. You don't get to recognize it as income, and you don't get to write off the losses. Somebody says the maximum forgiveness under PPP. This is clarification on this one. Where is that one? There we go, the PPP. How is the forgiveness for the owner's salary? It's up to $100,000 a year divided by 12, so it's $8,333 is the maximum amount per month. So you have 2 months of that, so you're going to be right around, what is that? 16,666, whatever that is. Yeah.
Yeah, the owners treat it like any other employee.
Yep.
For the PPP.
And if you're a sole proprietor, then it's whatever you've been taking out over the last 12 months prior to the end of January. So it'd be January going back to the February, or if you just set it up, it would be January and February average. All right. My mom is at 83, and when she dies, she wants to leave her house to me and your 3 siblings. She currently has about $100,000 in equity. So you sell the house. We're not worried about the taxes. Actually, when she passes, guys, the basis is going to step up. You're not going to owe any tax. So you're going to get more than, you're going to get pretty close to that 100,000. If you use a realtor, you're probably going to be paying somewhere in the neighborhood of $8,000 total. So you'd get 92,000 divided by 4, whatever that is. So 24,000 is about right. If you transfer it into the revocable trust, you will avoid probate. And if your brother and she are the trustees, she would be the master trustee, and she could have a co-trustee that she could toss your brother whenever she wants. It's not going to reduce tax liabilities other than she's going to step up in basis. Her house, if she's living in it, 2 of the last 5 years, would have the big exclusion, the $250,000 for her if she's single.
But only if she's still alive when it's sold.
If she sells it right after, don't they allow you to?
No,
go back?
because you get to step up in basis.
Oh, that's right. You step up in basis. That is immaterial. I don't know why I was thinking that.
I'd already thought about it while you were.
Yeah. Step up in basis just means if she bought it for $10,000 and it's worth $1 million, you pay 0 tax because the new basis is $1 million. So if you sell it after she passes, you have 0 tax.
Here's what you don't want to do, because my mom did it. Put it in an irrevocable trust.
Yeah, don't do that.
Because you get no step up in basis, get no $500,000 exclusion. Zilch.
All right. Don't do that. And the other thing you don't do is give your kids the property right before you pass.
No.
Because they get your basis. And we actually saw that happen too, when everybody was all worried about, the estate tax is going to come back. A nice gentleman gave his kids the entity that held a building and completely lost the step up in basis. And the kids are like, why did the accountant do that? And I said, because they wanted to make some money on your dad, and freaked out. Which all the accountants out there you can kind of identify with, is they were being a little too sky is falling, and they did something that cost their kids a lot of money. It's not actionable. You're not going to sue the guy over it, but you're still looking at it going, you were worried about the estate tax. And at the time, I think that he passed in a year where there wasn't even an estate tax. So it's great.
2010.
2010, that's about it. All right, purchased rental property, did a cost segregation, very smart. Property appreciated greatly, did a 1031 exchange after 10 years. Wouldn't the fair market value of the 1045 property have to separate out and the gain recapture as ordinary income? You would think, except because a 1031 does not apply to 1045
1245.
property. It's 1045.
No, it's 1245 per property.
Oh, you know what? You're absolutely 100% right. But that's what you wrote. So I'm just going to say 10. It's 12.
No, I saw the question come in. That's what he wrote.
So what you're worried about is, because otherwise everything else is 1250 property. That's regular. That's the structure itself. And that is okay. We're going to give it a smiley face for a 1031. And 1245 is negative. But when you're talking about personal property in a 1031 exchange, we use the state definition, which is anything added to a property is not considered personal property. So you don't have to worry about it. It's going to be included in your 1031 exchange, unless it's some furniture or something sitting around.
Yeah. Most of you, here's the thing about 1245 recapture. 1245 recapture is limited to your gain on that 1245 property. Mm-hmm. And most of this 1245 property is going to be worth close to zero. So you're not going to have any gain on that 1245 property. Nobody is actually paying you for it.
No worries. Yeah, unless you did it and like you held it for 10 years. So, so here's the concern. Hey, I wrote off 100%. Let's say I cost segged and wrote off 100% of my 15-year property. So in theory, there's 1/3 of it left, right? And you think that, oh, I'm not going to be at a 1031 exchange. Yes, you are, because 1245 property, it's not the same definition. The definition under 1031 says, let's look at the state. The state does not have the definition of 1245. They have the definition of personal property that's attached to a structure is the structure. So if it would damage it to remove it, it's part of the structure. So then we don't have to care about it. So that's a tricky one. I love it when somebody comes in and has those types of questions, because it's like, yeah, it's that weird little nuance. Somebody says, wouldn't they want to create a revocable trust to avoid the probate and the time delay? Yes, Jay. That's back here on this guy. Yes, you still use we do the revocable trust. So we do this. This is A-OK, smiley face. But it doesn't do anything for the taxes at all. We don't care about it. We're not going to give it away early. Then somebody says, what about a ladybird deed? Used for the house before the parent passes, you'd still lose the step up. Yep. Some people do the ladybird deed, which is they're allowed to stay in it, and then it goes to somebody else. I think that's what I'm reaching into there.
I'm not familiar with that.
There's two different types of deeds. I want to make sure I'm not forgetting it. It's almost like a paid on death. There's a ladybird where they have the right to stay in it, and it's excluded for Medicare purposes. And then there's another one where it's a transfer. You have to look it up because I'm going to forget.
I was thinking of the Cooper Trust, the Qualified Principal Residence Trust.
Yep, it's a life estate deed where they get to stay in it. Yeah, so I don't do that stuff. And if you do a revocable trust, don't you file a tax return for it every year? No, you don't ever have to, because it's a grantor trust. So it's you until somebody passes, and then it's somebody says it's a driving this Davy trust. You guys. All right, you guys have really stuck in there. I'm sorry. I knew that I grabbed too many, but you guys are troopers. Always feel free to jump into our podcast. I feel bad for Susan and Patty because they have to sit through this. Transfer on death deed or life estate, that's the ladybird. Yeah, so we're not going to keep worrying about that. Use a revocable trust so that you can very easily, we go 2 hours.
I was just going to say we got done before 5, and you went and answered another one.
I'm sorry. You're getting blown up. All right, replays in your Platinum portal, or we always send them out, or go on to our iTunes and grab our podcasts. We break these out. Google Play, we break these out, and you can listen to them. You can't see Jeff's pretty face. One of these days, we're going to start doing them with video. We have a room for them.
I got to get a new picture for our front page.
And look at that. You can always jump us on social media. Shoot us questions on Tax Tuesday. Hey, somebody said it's only 2 p.m. in Hawaii. I am so jealous. I have a very good friend, and his wife is on Maui and does all these beautiful pictures of the turtles, and it is so gorgeous right now what's going on with the people not being jumping around. Hey, somebody's in Brazil, 9 p.m. My wife's from Bogota in Colombia, and that the Miss Olympia was from Brazil this last year. So I don't know, you guys should be cheersing the Miss Olympia bikini, I should say, not the bigger the big muscle, but this is the anyway. So yes, lots more turtles, way less people here. So I want to go to Hawaii. I think I'm just gonna live there. I'm gonna find somebody's backyard, and I'm just gonna put a tent out there. Yes, way less people. Come on over. Gonna do it. All right. Hey, send in your questions. Tax Tuesday at Anderson Advisors. Visit us at andersonadvisors.com. Stay safe. Call people that are in quarantine. Make sure that they have someone to talk to. say, oh, you're on the North Shore, so you're over by Turtle Bay. Oh my goodness, I'm so jealous. It's so gorgeous. He's over, like, you'd actually like it. So this is completely as an aside. Somebody else was over there in South Africa. I have a friend in South Africa too, so you have to meet Jan Potgieter. He's over there. I've gone hunting over there in Johannesburg, outside of Johannesburg, obviously. But what was I going to say? I completely he is an optometrist. His name is the same first name as the gentleman who got shark attacked in Maui and passed away. Like, it's horrible. The guy retires. He was an optometrist from this guy's same state in Alaska, and everybody's freaking out thinking it's my buddy, because he also retired and hung out and lives on Maui, and everybody, like, what are the chances?
Right.
Like, very few shark attacks, but that was like one of the weirdest things. So I'm looking at it going, oh my God, like, he passed. Oh my God. So I'm reaching out. He's like, no, it's not me. Everybody thinks it's me. I'm like, oh, anyway. So anyway, SAA went out of biz yesterday. Ooh. So so there's here, Africa's a great place for Californians. Eric, you're in rare form today. All right, guys, thanks. Be safe and have a good one, guys. Let's all make sure that we're helping the small businesses that start to reopen, because, man, they took the brunt of this. Hopefully we get through all this. Hopefully we get some sanity and you guys are able to do okay. So, South African Airways. Oh my God, that is horrible. But oh my goodness, I've actually flown them, Glenn. That is horrible. Poopy. And so anyway, yeah, we're hurting in Hawaii big time. Absolutely. Everybody's really feeling it. So do nice to all the little businesses, because boy, and if you need to get your nails done, Jeff, you should get a pedicure.
Yeah.
And a mani. And do business with these folks, because man, they just got leveled by most of the states. We won't talk about the constitutionality of shutting somebody down, but I know we need to get through all this, but just help everybody that you can. All right, guys, thanks.